Times of market volatility enable us to do what we do best. We have a pipeline of names. It's an opportunity to buy great businesses, so we go shopping.
War and credit concerns. What do these twin risks mean for investors?
One has to consider the difference between a slowdown versus a breakdown.
To get perspective, we talked to Amritha Kasturirangan. She oversees $30 billion in assets focused on U.S. dividend growers. Dividend growth in a time of war. How do you think about your portfolio? Have you made any adjustments? One poster child of software anxiety has been Microsoft. Is this one of the stocks that you say is on your shopping list?
Microsoft is a name that we believe will be a long-term winner.
Credit quality, credit scare. It harkens back to 2008. What is your thought process on private credit? When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. In this episode, we discuss Microsoft, which is a stock that I own. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. We have seen a very volatile week, and basically the script goes like this. Anytime words like peace or ceasefire are dropped, we see the markets rally. Anytime there's anxiety that might not actually take place, we see the markets sell off. It's against this backdrop that we speak to Franklin Templeton's Amritha Kasturirangan, who manages a $30 billion portfolio of U.S. dividend growth stocks. And yes, she likes the dividend growth, but she uses a company's ability to grow dividends in good and bad times as almost a proxy for a defensible business in an environment where markets are volatile, like we find ourselves in now. She also says in a market where we've seen a big downdraft because of things like private credit and software, that she's doing what she does best. She goes shopping. She's finding those opportunities. So we're going to take you along on this shopping trip. We talk a lot about stocks as well as the big picture. And a reminder, we are still doing our giveaway. It's so easy. All you have to do is be a subscriber, comment wherever you're listening. We pick one winner every episode to get this market cap or this, this is not the liquid assets mug, but it's a fun mug that we have. Girls just want to have funs. Maybe we'll throw that into another giveaway. Or if I ever get this swag store open, we will try and sell you this mug. But for now, you can win this hat and the liquid assets mug. Just comment wherever you're listening. Let's get into it. Amritha, thank you so much for joining me on the show.
My pleasure, Amber. Very happy to be here.
You run a dividend growth strategy primarily for U.S. stocks. It's a huge mandate, $30 billion. Talk to me about what that looks like, because we're going to talk a lot about your holding, and the yield won't look that high.
Correct.
But that's not what you're looking for.
Exactly. So thank you very much for having me. My name is Amritha Kasturirangan. I'm one of two co-lead portfolio managers on the Franklin Rising Dividend strategy. It's a long-established strategy. It's been around since the 1970s. It has $30 billion in AUM. And I'm happy to talk a little bit about how we approach investing, if that would be of interest. So in essence, what we do is we use dividend growth, sustainable, substantial dividend growth as a flag for a resilient type of business. And the portfolio in aggregate translates to the following value proposition. So good through cycle participation, but with a particular emphasis on downside protection at times of investor uncertainty like this one. So historically, we've exhibited downside capture of around 70 to 85% versus the S&P 500. And our process marries a very disciplined quantitative framework with more subjective, fundamentally driven qualitative analysis. So
it sounds like it's for more a risk-averse type of investor who still wants to participate in equity upside. You're not just here purely for the dividends, but you're using your ability to grow your dividends as almost a proxy for a defensible business.
Exactly. So the dividend growth, I'll talk a little bit about the quantitative framework because that will illustrate the underlying principles. So broadly speaking, we use 4 screens to define our investable universe. And they're essentially looking for a company that has the ability to grow dividends in 8 out of the last 10 years. So through times of thick and thin, that's typically the length of an economic cycle, meaningful dividend growth, so at least high single digits. And that's really just a derivative of underlying earnings growth, sound balance sheets, and a commitment to reinvesting in the business.
What happens if a company cuts a dividend and you own it?
So,
has that ever happened?
It has. Now, the simple answer is that the clock starts ticking again. But we have the flexibility to look at things on a situation-by-situation basis. So, for example, one of the names we really like is ROST Stores, which cut its dividend or ceased to pay a dividend during the pandemic because it couldn't open stores. But once it could, it resumed paying that dividend at a healthy clip, and we gave it a pass. It's still a great business, and we like it very much.
We're going to talk about that.
We are indeed.
One of your top ideas. But before we get into it, you did mention, holding these companies through thick and thin. I think we're in thick right now.
The dividend growth has to be sustained through times of thick and thin because that exhibits a resilience in the underlying business model.
And I want to bring that to the time that we're in right now. Yeah. Dividend growth in a time of war. How do you think about your portfolio? Have you made any adjustments since the beginning of March when war broke out? And as an investor who's a long-term investor and is looking for that sustainability, what's been your thought process over the last couple of weeks?
Oh, sure. So I want to take you back for a microsecond to the beginning of the year. So let's remember coming into 2026. Inflation was manageable. Labor market was holding up, on track for Fed rate cuts. And I'm going to argue that this administration has, in terms of concrete actions taken, been broadly pro-business, pro-growth. So we had the extension of the tax cuts, which was important, not talked about enough, but it was important. We had deregulation. We started to get clarity on the tariff landscape. And arguably with all the reshoring, with some of the reshoring that was going to happen, especially in strategic industries like semis, defense, maybe even pharmaceuticals, you had some signs of a pickup in industrial end market activity. So what I'm trying to say is we were cautiously optimistic at the beginning of the year and fundamentals were holding up reasonably. Now, the debate seems to have shifted because of geopolitical tensions in the Middle East to calling the duration of this conflict. You've had energy-driven inflation spikes. And in essence, the conversation seems to be, well, how long could this drag out? And then does the impairment become longer term and structural as opposed to a quick rebound? And I'm going to give you some insight into what we're thinking about. So we can't call the duration of this conflict with any accuracy. But
I don't even know if the U.S. can.
But a few things. Firstly, the timing of midterm elections and the rising price of gas at the pump. So if you start getting close to a 5 handle that starts creating massive consumer anxiety, those should act as natural brakes on this administration to prolong the war. I don't think they want to, but those are hedges to bear in mind. Secondly, if you do get a return to normalcy, all the positive factors I talked about, and I left out a very important one, which is the AI productivity cycle is just getting going and is arguably somewhat independent of these macroeconomic factors. That's a huge driver of the stock market. Those still hold. And lastly, I'm just going to ask you to cast your mind back to last year. So when Liberation Day was announced, sharp fall off in the market, talk of the end of American exceptionalism, the speed with which the market rebounded once it became clear that we were going to get clarity on the tariff landscape, deals were being struck. Essentially, I spoke to a number of CEOs during that time, and what they said is, look, we just need to understand the new playing field. We will then reroute supply chains. Once it became clear you were going to get that, the market recovered. So what we do as active managers, times of market volatility enable us to do what we do best, We have a pipeline of names. It's an opportunity to buy great businesses at valuations you might normally not get. So we go shopping.
And we're going to find out what you're shopping for. But, it would be so easy to buy into that thesis, maybe easier. And the market is. As soon as, a piece or the prospect of piece is floated, the market rips. So the market's already telling you it wants to do this.
Yeah.
It wants to believe that once this goes away, all the good times come back. Except that's not the only challenge facing the market right now. Before Iran, there were cracks forming in an area of the market called private credit. We've seen software run over because of AI scares, and it's knocking up against these financials, asset managers and even banks on concerns of A, what are they exposed to? And B, retail investors who just don't want to hang out to see what they're exposed to, so they're pulling their funds. So you have kind of a run on the bank that is related to these kind of AI software concerns. So you thoughtfully took me through your thought process on Iran, and I wonder, what is your thought process on private credit? How big is the problem, and is that not a cause for concern?
Sure. So I think there are two things we have to address in your multifaceted question. The first is the AI trade. So it already changed heading into 2026, and one could argue in a healthier way. So 2025 was all about the large language models, the build out, and the chip manufacturers. And now I would argue that trade has expanded across the AI ecosystem. Of course, utilities and power companies have gone up, but more broadly, I think emphasis is shifting to defining AI productivity benefits. And companies that can do that, they may be as wide-ranging as Walmart or Goldman Sachs, will have an edge. And that is arguably a healthy trade. It's a continuation of the broadening of the market that you saw with the election of this president. Now that is very naturally leading into a discussion of who are going to be relative winners and losers. And that's not a bad thing. And that is where you're potentially seeing some software or some financials companies where investors are saying, well, could this line of business be disintermediated or not, coming off a little bit? This is something that tends to happen when new technologies come to the forefront. So it is a natural thing, and arguably the broadening of the market is healthy. Now, with the private credit or the private equity asset managers, it's an interesting and it's a nuanced question. I think one has to consider the difference between a slowdown versus a breakdown. And so what the market is pricing in is credit risk, retail redemption risk, potentially a prolonged period for exits for software buyouts, and delayed realizations. And what it may be extrapolating is a complete collapse in fundraising. And that may be too pessimistic. So it may not be a very broad buy the dip moment. It may not be a situation where you have a systemic solvency crisis unlike in 2008. Could there be a slowdown in fee-related earnings at some of these companies? Yes. But if you still get mid-single to high single-digit growth in fee-related earnings, maybe below what was being assumed earlier, but still attractive at some of the highest quality names, say a KKR or an Ares, that could arguably still selectively be an attractive opportunity. So I think it's a question of what is the market pricing in? Is it overdone?
But it's not just a question of delayed monetizations or ability to fundraise. Isn't it also a question about credit quality? A lot of these are 2021 era investments that were made at a time of very low interest rates, largely into software, before we really knew how disruptive AI could be to software. And isn't there a greater concern of the credit quality of these businesses that they lend to, that we could see blowups, that these software companies do not have the same viability that they do today that they did when those first investments were made in 2021?
Yes, so you're getting a conflation of different, or a lot of different trends coming together, which I think tempts the investor to read into it a worst case scenario. So you've got a rise in interest rates. It's not as benign an interest rate environment as it was. You do potentially have the risk of disintermediation of some software models and questions around that. And it is difficult sometimes to disprove a negative thesis. So for example, if a software company, which is in the crosshairs right now of these kinds of questions, says, hey, earnings have held up just fine in the next quarter or the quarter after that, the market might still not believe them. So it will take a while to see which businesses are survivors and which ones not. Compounding that, you've got a situation of some illiquidity and a little bit more opacity with these investments because they're not publicly traded. So again, that builds up the fear behind them. The point is it going to be as bad as the worst case scenarios are pricing in right now? We're seeing some of these funds allowing more redemptions. We're seeing financing continue, especially at the strongest names. So if you focus on the highest quality names, which perhaps have less direct credit exposure, it's more a question of will their fee-related earnings growth persist at the levels that was assumed. They could still be relatively attractive investments, and the risk you're talking about could be contained.
And you mentioned two names, KKR and Ares.
Correct.
So those sound like two. You own those, and you would buy that weakness.
Investors have to be comfortable with the risk factors that you raised. But the point is, selectively speaking, there may still be opportunities in this maelstrom. And this is the point at which I think active managers can really make a difference.
And I think it's important to understand within these businesses, we're talking about KKR broadly.
Correct.
Let's use it as an example. It does so many things. And the problem child isn't necessarily across all the funds.
No.
It's across these business development companies, these BDCs. Help us understand what those are and how, I guess, the percent exposure that like a KKR has to this. So if there happens to be trouble there, how ring-fenced or isolated is it for a company like KKR?
So business development companies tend to be publicly traded vehicles that invest in these private credit assets. The precise degree of exposure, KKR segmentation is not one that comes to mind immediately, but I think given the diversification of KKR and Ares, these are names that we own across different asset classes, the strength of their balance sheets, their risk-taking capabilities, in aggregate, we don't believe that this will be risk that they can't manage.
And I think a lot of people, there's a habit, you've been in the markets for a long time, credit quality, credit scare. It harkens back to 2008.
Correct.
And just wondering, maybe the instinct to, I want to be that person who calls it. But I think it is important to put some context around like how big you think this problem is. From a broader perspective?
No, it's a very good question. I think you're absolutely right to call out the tendency to emotionally anchor, especially back to situations that were as catastrophic as the global financial crisis of 2008. Now, there is a difference here in that the money center banks were at the heart of the issue. They carried most of the risk. And you had a situation of opaque securitization, you had high leverage, and it was concentrated in entities that were arguably at the heart of the financial system. They're much less exposed this time around. They're more involved in fund level lending. They may have credit lines or securitization lines to these BDCs or to the private credit funds. So the problem is more restrained to a corner of the market, which is admittedly developing. Part of the attraction of these asset classes has been that they have had the freedom perhaps to operate in ways that publicly traded assets have to abide by greater regulatory frameworks. But I think I don't have an exact answer as to what the scale of this could be. But at first sight, it seems more restricted. It seems less likely to lead to a systemic solvency crisis, as was the case in 2008.
And do you have confidence in any of these asset managers that you own that are potentially exposed to this problem? Going back to your original kind of worldview around dividend growth, does this dent their ability, you think, to grow dividends? Or would you look at that as a sign, okay, this is manageable?
So the hypothesis for us for investing in these names was that growth in fee-related earnings should be healthy, should be relatively sticky. Bear in mind, most of the institutional capital underlying that growth in fee-related earnings is locked up. It's difficult to reset rates on that. And even though retail capital might be relatively flighty, institutional capital and insurance capital is not. So one could assume the growth in fee-related earnings should still continue at an attractive clip, and dividend growth would fall out from that. So we're still confident in the dividend growth prospects of these companies.
I guess we should also talk about the fact, though, that even if they're not compromised in their ability to raise funds, that their cost of capital, I mean, we're looking at the credit markets, right? The cost of capital is going up.
Correct.
What does that do?
I don't necessarily think as an investor that that's a bad thing. It brings a discipline to investing perhaps that wasn't present before. And these are some of the world's most sophisticated investors. So I think that's comfortably factored into their future plans and their approach to investing. So.
Okay, well, you mentioned that you're looking for opportunities in the markets. Let's see if we can find them, and we'll dip into the mailbag. This ETF Minute is sponsored by Hamilton ETFs. This video is for general informational purposes only and not personalized investment advice. Are you nervous about investing in tech because it's so dominated by a handful of stocks? Hamilton ETFs has a low-cost solution for that. They've launched the Hamilton Champions U.S. Technology Index ETF, QMVP. Instead of investing in the largest valuations, their approach is to invest in the most profitable tech companies. You still get the Mag 7 and names like Alphabet, Meta, and NVIDIA, but they limit how much influence one stock can have over the index. For example, in the S&P 500 Tech Select Sector Index, NVIDIA is 15% of that index. QMVP, on the other hand, uses a modified market cap approach, rebalancing each holding between 2 to 6% every quarter. You're still getting semiconductor exposure, 40% of the ETF, but it's just less concentrated in a few names. Now, their approach ensures that only the most profitable and established tech companies are included. And history suggests that this is the way to win. The back-tested index significantly outperforms the Tech Select Sector Index. Bottom line, it's a more diversified way to play a traditionally momentum-driven sector. For more information about QMVP and the Hamilton Champions suite of ETFs, visit hamiltonetfs.com. Okay, well, picking up from the conversation we were just having, a lot of our questions in the mailbag actually stem from what's going on with either AI or private credit or software. And I think one poster child of software anxiety has been Microsoft, which is interesting because Microsoft, of course, with its close ties to OpenAI, was a strong performer in the AI trade. And now it's down 30% from October. Is this one of the stocks that you say is on your shopping list?
So Microsoft is a name that we believe will be a long-term winner for a variety of different reasons. I think some of the downdraft in the stock is related just to the point we discussed earlier, which is a broadening of the AI trade, which is arguably healthy beyond a narrow group of mega cap tech names into the broader ecosystem, defining who perhaps the other implementers could be or other beneficiaries of it could be. But Microsoft is a name we have liked for a long time because of the diversification of its platform. Remember, cloud still remains an important driver of revenue growth. Its watertight enterprise relationships, it is a trusted IT vendor, and its critical role in the development of AI infrastructure and AI applications down the line. Now, yes, the relationship with OpenAI may be tested as OpenAI seeks more independence, but I think for Microsoft has access and will probably continue to have access to OpenAI's large language model as well as its own, which it develops in-house on which to build an array of applications. So relatively speaking, amongst the mega cap tech stocks, and even on a standalone basis, it remains a very attractive investment opportunity. But the AI trade is broadening.
It trades at a market multiple, and I actually can't really recall the last time you could buy Microsoft that cheaply. Now, things are often cheap for a reason, and we've talked about that AI concern. Having said that, though, do some of these stocks warrant just a new multiple that it's, maybe you can argue it's trading excessively cheaply, but maybe it shouldn't go back to the multiple it was before. It doesn't mean the stock can't go higher, but like, is there a new normal for a software company like Microsoft?
So, what we've seen, and this is true for companies that perhaps are entering a period of hyper growth, multiples can shift around a lot. Inevitably, there's a period when the market extrapolates what the end demand or the end market could be. Then there's a period of digestion and pullback. And then frequently what ends up happening is that the ultimate TAM achieved is greater than investors originally thought.
Total addressable market.
Yep. Correct. Thank you.
I got to translate those acronyms.
So in the case of Microsoft, sure, the multiple could come off a little bit at the moment, and it might make it an attractive entry point to build out undersized positions because we believe it will be a long-term winner. This is a very high conviction name for us. We have a pretty, I would argue, a pretty full-sized position, but we do have confidence in the long-term prospects. The only question for us is, I think looking at the array of options that are opening up with respect to the AI trade, there are companies like Goldman Sachs and Walmart that have talked about how AI could enhance their productivity, how they're taking it up to improve the efficiency of either their supply chain and logistics in the case of Walmart, or for Goldman in the case of the work that its analysts do. That is going to be a very, very interesting trade over the next few years as these AI benefits percolate across the broader economy.
Walmart is so interesting because it switched. It doesn't trade on the New York Stock Exchange anymore. It trades on the Nasdaq. Yeah. And the stock actually, since it made that move, popped higher. It's got this new CEO, and they put a lot of, AI halo around him because it's going to be the new CEO, John Furner's job to usher Walmart into the AI era and what agentic search and all of that means for discovering products that you can buy through Walmart. I think that speaks directly to what you're saying. Like, you think about Walmart as like a consumer play or whatever. Actually, is it an AI stock?
So it's a good question because the definition of an AI stock is probably going to broaden to who can utilize this technology most effectively, not just on the companies that are involved in building out the infrastructure. And I will point out that Walmart, for all the fact that it's been around for so long, has reinvented itself even before AI showed up. It leaned heavily into e-commerce. When it felt its core business was being threatened by Amazon, it built out a very successful e-commerce business. And now, if you like, there's another iteration of Walmart coming up. So to utilize this next generation of AI to achieve efficiencies. And it's interesting, when I met with IR from the company a few months ago, they were talking about impacts not only on the bottom line, but also on the top line, utilizing it in conjunction with some of with ChatGPT or some of the analogies to actually put Walmart inventory on there. Mm-hmm. So they're being very creative and showing a lot of initiative. And I was quite intrigued.
I mean, it's expensive.
Yes. So you've had a number of complicating trades in the early part of this year.
Yes.
You've had the AI narrative shifting. Mm-hmm. Then for a period of time, because of the SaaS disruption that you alluded to, you perhaps had investors seeking safety in certain names. Walmart, I think, would have been a recipient of some of that. So yes, you have to distinguish between tactical ads versus long-term holds. This is a top 10 name for us. We think it'll do very well. But yes, the multiple has run up. And I think, one thing to bear in mind is if, for example, we do get a relatively rapid resumption of normalcy with respect to the Iran war, does the AI trade resume? Does the safety trade come off? Something to bear in mind.
One stock, and it's really a whole sector, but we can talk about it through Nasdaq. And we have a question from Louis on this. That Are stock exchanges truly at risk from AI? They're certainly trading like they are, and exchanges, they've become so much more than just that. They're data companies. Yeah. They're provider of software and intelligence to a lot of the companies that list. And Nasdaq is a perfect example of that. How do you think about disruption from Nasdaq's perspective?
Right. So there are two ways I'd answer that. One is I think the core exchange function of providing liquidity, the need for that doesn't go away, to provide a central forum where that can be accessed. Now, AI might on the margin make execution more efficient, which could lead to some spread compression, but the core exchange function, I think, will persist over time. Now, it's the other stuff you talked about, which is interesting, the surveillance products, the indexing products, the data analytics products. Right now, there are questions being raised about how vulnerable are those, and quite rightly. With Nasdaq, what we have found over time in our interactions with the company, and again, it came up at the Investor Day, they are very much on the front foot with regard to bringing these AI capabilities in-house and using it to enhance their services and, in fact, develop products for their clients, which are in high demand. So I remember, I think it was at the Investor Day before this one, I was really surprised to find them talking about a large language model they'd built in-house to develop an ESG solution for their clients. So there's no black and white answer that could cover all the exchanges. But with this company, we think they're taking a very proactive approach. And that's what you want. You want a business to utilize this to make their offerings more attractive to their clients. So we think there's a good moat around Nasdaq because it is so receptive to its clients' needs, but it's also on the forefront of anticipating what they could need and making that a little bit better and using AI to do that.
Is that the only exchange that you own? So it sounds like you're being selective in this space.
I think you have to be. I think you have to be, broadly speaking, in given this discussion that's going on.
Away from some of the AI trade, we got question. Well, maybe not really. I think it could relate to Stryker as well. We got a question from Alan on X. Stryker recently took a hit because of a cyber attack, which it is addressing. But it's a med tech company, does a lot of advanced technologies that aid in things like surgery. The question is, how bad is the cyber attack on Stryker? Should I sell?
So we've held Stryker a long time. It has consistently delivered earnings growth at the top end relative to its medical device peers. And it owns the leading orthopedic robot. Now, you and I are a few years away from needing this, but at some point, if we need a hip or knee implant, it's quite likely that we may be operated on by a surgeon who uses the Stryker robot. And it's well ahead of its competition. So the company has very attractive fundamental strengths. Now, the cyber attack, what they have told us at this point in time is that it did shut down their systems for a few days. Orders were delayed. The precise impact, I think we'll only get clarity on when they next report earnings. But so far, it seems to be a relatively contained issue.
And it's not like you could get scared off by this, but is there a substitution?
Not really.
So it's not like a customer can be like, well, I didn't like this cyber attack, so I'm going to...
There are competitors, but it's not that easy for hospitals to switch immediately. Now, if this prolongs, yes, it could be an issue, but so far there aren't indications that that is the case. And we haven't really, we certainly wouldn't sell on this news.
Robotics does feel like the next frontier after efficiency in terms of where the AI trade broadens. How do you think about like med tech getting swept up in that trade or in the evolution of where this technology is going?
So I'm going to answer it a little bit more broadly, and then I'll come back to medical devices. Healthcare, I think, is going to benefit greatly from the uptake of AI, even if that entails some disintermediation, and that will affect various different subsectors. So it could improve the R&D productivity of biopharmaceuticals. It could improve workflow processes within hospitals, even within perhaps insurance companies. For the medical device companies, I think they have been utilizing certainly increasingly sophisticated data analytics systems for a while. And this next generation of AI could take that to the next level. So for example, it's not just Stryker, it's also Intuitive Surgical and some of the others. They've tried setting up ecosystems whereby doctors can talk to each other, can observe each other's surgeries, can see radiographic images and comment on them with perhaps pre-surgery planning. And so AI will likely, or it could improve the efficacy, the accuracy, the speed at which patients recover from these surgeries. I think it's very, very clear that it could be additive.
I'm going to spend an extra beat on this, even though it's clear from our viewers, they have no interest in healthcare. Just like we've done a few healthcare episodes, I can't tell you, the ratings are just so low on them. And you look at the stocks, Intuitive Surgical, I know had a very ugly quarter, but even Stryker, like there is AI optionality, and there's just such a degree of like, who cares around healthcare? I know part of your background is you started in focusing in healthcare. Am I right?
Yes.
Do you feel that? Like there's a big who cares about healthcare right now?
So healthcare, I think, has a few structural challenges in the United States, which I think is what makes it so ripe for disintermediation. Healthcare inflation has been well ahead of other inflation in other categories, and this is not sustainable. And then last year, I think biopharma had a particular overhang from the combined threat of tariffs, but also reference pricing relative to Europe. And now that overhang is cleared. Managed care took a little bit of a beating because you had reimbursement cuts from both a Democrat as well as a Republican administration. And medical devices, which I would argue have been relatively defensible over time, delivered very good growth. Perhaps there was some intra-sector fund rotation more into biopharma now that overhang has cleared from the sector. But the underlying fundamentals, particularly I would argue for good medical device companies like Stryker, is still very, very solid. And I am looking forward to seeing how AI plays out in these sectors. Do they resist it, or do some companies embrace it? There is a lot of room for efficiencies, whether it's something as simple as a doctor recording a conversation with a patient as opposed to writing it down, whether it's, AI or computers can frequently do better image analysis even than human beings, which is a little bit scary. Whether it's AI coming up with new molecules to develop that perhaps have a greater likelihood of success. So healthcare has been under a little bit of an overhang for a few years now, but I think that also makes it ripe for disintermediation because there seem to be intractable problems due to regulatory protection that perhaps AI will overcome.
Okay, well, let's see if our listeners pay attention to that. We have two more questions in the mailbag before we get to your pro picks. One is on a home builder. This one coming from Frankie, asking specifically about D.R. Horton, but also about the sector. Is this sector ever going to see a rate cut? Is there any reason to be bullish? And we just got results this week from KB Home, another home builder, who was talking about the Iran war. I think maybe the first company to blame the Iran war for disappointing results, but saying it has slowed down buying intentions over the last couple of weeks. I don't know how much of that is a convenient excuse because the quarter predated the Iran war, but man, a sector that has really had a tough time.
So Frankie, I feel your pain. However, we like D.R. Horton very much.
Why?
I would point to one very fundamental truth, which is that there is a structural undersupply of housing in the United States, and there has been since the global financial crisis. I've seen estimates as high as a shortage of 1 million homes, especially for the entry-level buyer. That is precisely what D.R. Horton does. So I visited some of their communities in Texas. You can get a 3 or 4 bedroom home for $320,000 with 200 basis points shaved off of the prevailing mortgage rate.
Like, sorry, we're in Toronto right now. I think everyone will need to take a breath. So they're going to go on and check out, okay, how are the schools in that neighborhood in Texas? That's wild. I think still our average home price here is $1 million.
Right. So there is an acute need for this. And I think what was indicated to me that the typical buyer for one of these homes might be, say, a plumber married to a nurse. It's people who are really looking for a solution to the question of affordability. So Horton and some of these other builders really cleaned up after the GFC. So they became much more focused on turning inventory fast, on returns. They lowered their leverage. They became more asset light. So they're fundamentally more attractive. Now, in the near term, I think mortgage rates may settle at the 6 to 6.5%. That's not going to drive a massive uptake of homes per se. These are volatile stocks. Nothing is going to change that. So what we do is we're tactical about when to add. But we are also believers in the long-term thesis that structural undersupply has not materially diminished. There is going to be a need for more entry-level housing. We think these guys will play an important role in providing that. So if you can stomach the volatility and if you're in it for the long run, stick with it.
And in D.R. Horton particularly, because you could do a Toll Brothers as well, but that's more on the high end.
It's more upper income, and it tends to be smaller parcels of land in urban centers I don't know if Toll Brothers owns something in Toronto, but for example, in markets like Toronto. Whereas Horton is more exurban land or suburban land outside smaller cities. It's cheaper, and it doesn't tend to have much land on its books, which I think is important.
Our final question is about an energy stock, Exxon. Exxon Mobil on the back of the Iran war, a good entry point. I'm pretty sure Exxon's at a record high already, but we can talk about, let's talk about this in isolation, Exxon and the Iran war, but then I also want to talk about your philosophy around energy companies, because there's been kind of a vibe shift about dividends and growth there. So first, let's talk Exxon and Iran. Do you have any thoughts?
No, it's a good question. So look, we regard Exxon as a high quality oil beta play. It's integrated, it does upstream, it does refining, it has chemicals capabilities. So we like it for that exposure. We think it's important. The question asked is, again, really a call on the duration of the Iran war. If you believe it's going to prolong for, say, 6-12 months and oil is going to remain elevated above the $90 range, then sure, perhaps even at these elevated valuations, there's a case to be made. But from our perspective, as I said, we would argue more for a return to normalcy sooner rather than later. And if you look at the oil markets today, in contrast to the stock markets, I would say the market is also pricing that in. So,
I mean, but even like if it drops, but it drops to $70, that's still a very nice life for Exxon.
Correct. And, we would argue that perhaps structurally, operationally, these companies might be higher quality than they were, say, 5-10 years ago. So they are attractive. One could arguably treat them as healthy long-term holdings. But again, the question about whether to buy today as a function of a call of will this conflict drag on for another 4 weeks, 6 weeks, 8 weeks, it's something that,
How about outside of this conflict, to my question about just the energy sector in general, and has it matured enough to be on your radar that you're willing to own it because they are strong dividend growers, outside of needing to have a call on the commodity? Or is that just not possible?
We own Exxon, Chevron, EOG. So we do like the dividend growth prospects of the sector. We do have exposure to it. What we have pivoted into, which is related but not identical, is owning more utilities. So those have, I think their growth rates have structurally stepped up because of a need for more energy demand related to perhaps more investment in infrastructure, reshoring, and also data center growth. And that, became very attractive to us. So we've materially increased our exposure to that sector. Nextera, WEC, Ameren.
Okay. I'd like to give our audience names. Okay, let's get into your high conviction ideas, your pro picks. Pro Picks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, I love these picks because they're not necessarily household names.
No.
So there's some opportunity there. Parker Hannafin, an industrial, some aerospace flavor, some defense flavor, low dividend yield, but it has been growing its dividend, so it meets your criteria. Talk to me about what the play is here.
It's a self-help story, which is particularly attractive in this environment of macro uncertainty. And it's basically re-rating from being viewed as a cyclical machinery company to more of an industrial compounder. And that self-help story is predicated on 3 pillars. So one is a mix shift, as you alluded to. So aerospace, longer cycle, higher margin, end markets becoming a greater proportion of its exposure. And that's been a very deliberate portfolio shift on the part of the company. And somewhat related to that, structural margin improvements. So last year you saw EPS growth substantially outpacing revenue growth. And that's come from a commitment to lean, more disciplined pricing, the aforementioned mix shift. And lastly, there's a little bit of a virtuous M&A flywheel going on too. They've done some good bolt-on and larger acquisitions, and as they fold those in, those are working out very nicely. So I mentioned this, as you said, as a name that maybe falls below the radar when everybody's just thinking about AI, but its self-help stories are particularly attractive in this environment because they just keep grinding on.
Now, it's pulled back with the market recently, but it was on a very nice run. It recently hit a record high. And the question is, has that thesis already played out, or you think there's more room?
No, we think that this could be a multi-year run for this name.
Analog Devices is your second pick. Integrated circuit maker also has a little bit of a defense angle to it. Does it provide?
So it makes analog chips, and what these basically do is they convert real world phenomena, so temperature, motion, power, sound, into digital data. And so it's a very nice, it brings some diversification to a tech portfolio because these analog chips are used extensively across a variety of end markets. So we've talked about a number of these themes today. So with more industrial automation, with more robotics, you need more of the sensors that incorporate these chips, the Internet of Things, greater use in greater incorporation in electric vehicles, which use 2 to 3 times the analog content of regular internal combustion engines. And even in your own car, Amber, if you think about driver assistance systems and the like, so the stuff that goes beep when you perhaps veer into another lane, those incorporate greater use of these chips. So even though there's a cyclicality to the business, these secular tailwinds are very, very long term, and we like that they have such a long runway. It also provides a nice counterpoint to just AI related tech exposure.
It's diversified, yes. So defense is one part, but as you said, automotive, aerospace, all sorts of, and then consumer applications.
Yes, in terms of the Internet of Things, appliances and the like.
Again, another stock that has run up, pulled back a little bit. You still see that all of that.
This is a multi-year run. You have to bear in mind the cyclicality, and you have to be able to tolerate that, but very, very attractive for the long run.
Now, we teased this. Your third pick is ROST Store. Very different from the other two, but a retailer, not in Canada, but if you go to the U.S., you definitely see it. Targeted, like kind of off price. And I think what's interesting about this, I've been harping about, stocks that are at record highs. This one hit a record high like this week, which in a nervous market, I think is saying something, that it's still able to show that relative strength. What is so good about ROST Store compared to other off-price retail strategies that have not done as well?
So it's always nice to talk about a stock where consumers can touch and feel the product.
Yes.
So ROST is interesting. It's an off-price retailer. And what this means is, in essence, you can buy branded merchandise at deep discounts to department stores. And its fundamental strengths have always held. It's a very good operator, very lean, very frugal. Now, it misexecuted for a couple of years, between 23 to 25. And those were for a few reasons. I think they just didn't get the merchandising mix right. They also tend to cater a little bit more to a lower income consumer who is pressed by tariffs and inflation. And we think that there's a very interesting comp inflection going on right now. So firstly, I think they've gotten the merchandising mix right. That is coming through. But what is particularly interesting is that they have a new CEO who's changing things up a little bit. So this is a company very conservative that historically, one could argue, perhaps underinvested in marketing. So he's leaned a little bit more into that. Store refreshes. And the marketing is happening on Instagram. So they're drawing in a younger consumer who's still very attracted to this treasure hunt model. So firstly, the core value proposition of affordable clothing or heavily discounted clothing particularly resonates in this environment where the consumer is feeling some stress. But you've also seen trade down from the middle income consumer, which is really intriguing. You saw that post the GFC as well with some of the off-price retailers, and you're seeing that happen again. But over and above that, there's this new flywheel that the CEO has set up, potentially a little bit more investment in marketing, drawing in a younger consumer, refreshing the brand, giving it more visibility. And that's where we think it could have legs.
Is there e-commerce?
No.
That's what I was, I only see in-person stores. I look at Kohl's, I look at Macy's, and they're struggling. And then I look at ROST stores, and it's like a completely opposite chart.
And, we have, I've had so many internal debates about, you have so many online only channels right now, because could they ever become substitutes? But it speaks to the enduring attractiveness of this treasure hunt model where you go into these stores, you rifle through the racks, and you inevitably find one or two gems that you wouldn't find if you didn't put in the time. And that's very attractive to their consumers. So, yeah.
All right. Because retail can just be, it's tough, right?
You have to pick your spots.
You really do. And something can turn around, but then is it lasting?
So this is a business that has tended to do well in times, in both tough as well as good economic times. So, in conjunction with the ethos of our fund, we tend to look for these resilient business models, and this one has done well.
And that dividend growth, like I'm looking on Bloomberg, it's a low yield, but up 40%, more than 40% over the last 5 years.
Very committed to that.
Very committed to that. It has been an absolute pleasure. Thank you so much for joining me on this episode.
It's absolutely terrific. I hope your investors get something out of this.
I'm sure that they will. Amritha Kasturirangan joining us. Don't miss our next episode. We're doing a CEO spotlight. We've got Tim Gitzel, the CEO of Cameco, uranium, nuclear power, a deal with the U.S. president. We'll talk about it all. We'll see you on the next episode.